I am Dr. S. Maheswari, Assistant Professor, PG Department of Commerce CA, Vellalar College for Women. Now I am going to take a topic in management accounting, that is cash flow statement. A cash flow statement is a financial statement that summarizes the amount of cash flowing into and out of a company. This includes all cash inflows a company receives from its ongoing operations and external investment sources. It provides a detailed account of the cash inflows and outflows of a business during a specific period of time. Then we discuss about the importance of cash flow statement. First one, liquidity and solvency insight. It helps assess a company's ability to meet its short-term obligations and maintain operations. By tracking cash inflows and outflows, it reveals whether the business has enough cash to pay its bills, employees, and creditors. Next, financial health evaluation. It provides a clear picture of the company's financial health. Even a profitable company can face financial difficulties if it lacks sufficient cash flow. Conversely, a company can be cash flow positive while operating at a loss due to non-cash accounting items. Next, investment decision making. Investors use the cash flow statement to evaluate the viability of investing in a business. Positive cash flow suggests a company is capable of sustaining growth, paying dividends, and managing debt, making it an attractive investment. Next, operating efficiency. By breaking down cash flows from operating, investing, and financing activities, the statement offers insight into how efficiently a company generates cash from its core operations versus its financing or investment activities. Debt management. Lenders and creditors rely on the cash flow statement to determine a company's ability to repay its loans or interest obligations. If a business has healthy operating cash flow, it indicates the ability to service debt. Strategic planning. For company management, it helps in budgeting, forecasting, and planning future investments. It highlights the areas where cash management can be improved, such as controlling costs or finding ways to increase cash inflows. Next, cash flow patterns. It shows whether a company generates a consistent cash flow or experiences large fluctuations, which can be an important indicator of business stability and risk. Next, we discuss about the limitations of cash flow statement. Does not provide profitability information. The cash flow statement focuses only on cash inflows and outflows without showing how profitable a company is. It does not provide detailed or non-cash items such as revenue or expenses that can impact overall profitability. Next, ignores non-cash transactions. Non-cash transactions such as depreciation, stock-based compensation, and revaluation of assets are excluded from the cash flow statement. These transactions still affect a company's financial position, but they do not show up in the cash flow. Next, does not reflect future cash flows. The cash flow statement shows historical cash flows, meaning it only reflects past transactions. It does not provide projections or insights into future cash inflows or outflows, which are crucial for strategic planning and forecasting. Next, limited in providing overall financial health. While it provides insight into cash management, the cash flow statement alone does not give a complete picture of a company's financial health. It needs to analyze it alongside other financial statements like the income statement and balance sheet to assess the overall performance, solvency, and profitability. It does not address the quality of cash flows. The cash flow statement does not give an indication of the quality or source of cash flows. For example, cash generated from selling assets or taking on new debt may not sustainable sources of cash flow in the long run. Next, ignores changes in financial structure. The cash flow statement does not provide detailed insights into changes in a company's financial structure, such as issue or repayment of equity or debt, which may have a significant impact on the company's future operations and financial standing. Potential for manipulation. Some companies may use creative accounting practices to manipulate cash flows in ways that improve the appearance of their financial health. For example, delaying payments or speed up receipts can temporarily improve cash flow figures without truly improving the company's underlying financial situations. It excludes off-balance sheet financing. The cash flow statement does not always capture off-balance sheet financing arrangements that is example operating leases, joint ventures, etc., which can significantly affect the company's financial obligations and risk profile. The last one is lacks detail on profit margins. The statement does not provide detail on a company's profit margins or the efficiency of its operations. For example, a company might generate high cash flow but at low margin, indicating that it is not managing cost effectively. Next, the cash flow activities are divided into three main categories, that is operating activities, investing activities, and financing activities. The first one is operating activities. These are the core activities that are directly related to the day-to-day operations of the business. They involve the generation of revenue and the payment of expenses. For examples of operating activities are cash receipts from customers for goods or services sold, cash payments to suppliers for inventory or raw materials, and cash payments to employees, that is salaries, wages, etc. Cash payments for operating expenses like rent, utilities, etc. Interest received or paid on taxes paid, that is depending on the accounting standards followed. Then we see a small example for the operating activities. A company receives rupees 1 lakh in cash from sales to customers and pays rupees 40,000 in cash for inventory and rupees 30,000 in wages. The net cash flow from operating activities is 1 lakh minus 40,000, that is inventory, and 30,000 wages. Then we get the result for rupees 30,000. So the net cash flow from operating activities is rupees 30,000. Next, we see about the investing activities. These activities involve the purchase and sale of long-term assets or investments. Investing activities typically include the acquisition and disposal of property, plant, equipment, and investment. The examples for investing activities are cash payments for purchasing property, equipment, or intangible assets, and cash receipts from selling of a property like machinery, building, equipment, or investments. Then cash payments for acquiring other companies or securities, that is long-term investment, and cash receipts from selling investment or diversities. Then here is a small example for the investing activities. A company purchases a new machine for rupees 40,000 and sells an old piece of equipment for rupees 20,000. Here the net cash flow from investing activities is 20,000 minus 50,000, rupees 30,000. Here the negative cash flow shown. Next, we see about the financing activities. These activities relate to the inflow and outflow of cash from external financing sources. This includes transactions with the company's investors and creditors, such as issuing shares, borrowing and repaying debt, or paying dividends. The example for financing activities are cash proceeds from issuing stock or bonds, cash payments for repaying long-term debt or short-term loans, then cash payments for dividend to shareholders. For example, a company issues new stock and raises rupees 2 lakhs in cash. It repays rupees 50,000 in a bank loan. Here the net cash flow from financing activities is rupees 2 lakhs minus rupees 50,000. That is net cash flow from financing activities is rupees 1 lakh 50,000. Next, we see about the format for cash flow statement. The cash flow statement is divided into three types of activities, such as operating activities, financing activities. First, we take net profit before tax. Then we add non-cash and non-operating items which has been already debited in profit and loss account, that is depreciation, transfer to general reserve, goodwill written off, preliminary expenses written off, loss on sale of fixed asset, provision for doubtful debts. These are to be added to the net profit. Then we can list the following items, that is non-cash and non-operating items which has been already credited in profit and loss account, that is profit on sale of fixed assets or investment, income from interest and dividends, appreciation of fixed assets. After we adjust the following items, we can get the operating profit before working capital changes. Next, we adjust the changes in working capital. First, we add the decrease in current assets and increase the current liabilities. Then we subtract increase in current assets and decrease in current liabilities. So we can get cash generated from operating before tax. After that, we subtract the income tax paid. Then we can get net cash flow from operating activities. Then cash flows from investing activities. Purchase of fixed assets, sale of fixed assets, purchase of investment, sale of investment, interest received, dividend received. After adjusting the above items, we can get net cash flow from investing activities. Then cash flows from financing activities, that is proceeds from issue of share capital, proceeds from borrowings, repayment of borrowings, dividend paid. After adjusting the above activities, we can get net cash flow from financing activities. Then after adjusting the three items, that is operating activities, investing activities, financing activities, we can get the answer of net increase or decrease in cash and cash equivalents. After that, we can add the opening cash balance, that is cash and cash equivalents at the beginning of the period. We can get the answer of cash and cash equivalents at the end of the period. Thank you.